Friends, thank you for being here today. I want you to pause for a moment and think about the word fortress. That is the word Canadian banking officials, economists, and financial commentators have used for decades to describe this country's banking system. A fortress, impenetrable, rock solid, the envy of the world. They said it after 2008, when American banks were collapsing like cardboard boxes in the rain and Canada's Big Six stood tall. They said it in 2020 when the pandemic froze the global economy and our banks absorbed the shock. They have been saying it for so long, so consistently, and with such confidence that most Canadians have simply stopped questioning it. But what if I told you the fortress just lost a tower? What if I told you that on December 2nd, 2025, a 179-year-old Canadian bank effectively raised the white flag, not because of a rogue trader, not because of a scandal, not because of a black swan event nobody could have predicted, but because the math of 2026 made its continued existence impossible? What if the invisible force that was quietly suffocating smaller lenders finally squeezed hard enough to make one of them admit, in plain language, that it cannot survive? That is exactly what happened, and this part has already begun. Laurentian Bank, founded in 1846, the year before Canadian Confederation, is being sold for parts, not restructured, not merged, sold. The retail branches are being handed to National Bank. The commercial arm is being transferred to Fairstone, a private equity-backed alternative lender operating in what experts call the shadow banking sector, and the stock price jumped on the news. Here is the part nobody expects. Investors celebrated. They cheered the dismantling of a nearly 2-century-old institution. Think about what that tells you. It does not tell you that the sale was a triumph. It tells you that the market had already concluded the long-term business model was dead, and that getting cash now at any price was better than waiting to see what came next. That is not a success story. That is an autopsy with applause. Now, some of you are already thinking, this is one small bank. Laurentian is not CIBC. It is not Royal Bank. It is not one of the big six. Why should I care? And that is exactly the question I want to answer today, because this is the detail even analysts tend to miss. The collapse of a smaller institution is never the story. The smaller institution is always the messenger. It is the canary. And what the canary is telling you about the air quality in that mine is something every single Canadian, every single person holding deposits, every single pensioner, every single homeowner with a variable mortgage needs to understand right now. Let me be precise about the numbers first, because what I call the big secret of the entire system is always hiding inside the data that nobody reads carefully enough. In Q4 of 2025, Laurentian Bank reported a provision for credit losses of $18 million. That is the money a bank sets aside because it expects loans to go bad. It is the financial equivalent of a doctor starting to prepare for surgery before the patient has fully deteriorated. The year before, that same provision was 10.4 million. That is an increase of nearly 80% in 12 months. Not 8%, not 18%, 80%. This is not theoretical, it is observable. At the same time, Laurentian missed its earnings per share target. Analysts expected $0.78. Laurentian delivered $0.73. That is a 6.8% miss. Now, on the surface, a few cents per share sounds trivial, but understand what that miss represents. It means that commercial borrowers, businesses, real estate developers, operators are beginning to fail to pay their debts at a rate that even the bank's own optimistic internal projections did not anticipate. They looked at their own loan book, applied their own models, and still came in worse than expected. That is the sound of the crack forming in the foundation, and this is where the first domino falls. But before we get to the cascade, I need to take you back further, because the instinct in financial media is always to treat these events as sudden. They are never sudden. What you see in December of 2025 is not an accident. It is the final act of a structural failure that was years in the making. And to understand it, you need to understand the mechanism that was silently destroying Laurentian's margins long before the official announcements. Here is the part they never put in the official reports. Think about a pizza shop. You borrow money to buy flour and ingredients. You use that borrowed money to make pizzas, sell them, and keep the difference between the cost of the ingredients and the price of the pizza as your profit. That spread between what you pay to borrow and what you earn by lending is your lifeblood. It is called the net interest margin. For a bank, deposits are the dough and loans are the pizzas. Now, what happens when the cost of dough skyrockets and at the exact same moment customers stop buying pizzas? That is what the Bank of Canada's interest rate cycle did to institutions like Laurentian. As rates rose through 2023 and 2024, the cost of deposits the price banks had to pay to attract and retain savers went up, but simultaneously, the demand for new mortgages and commercial loans slowed dramatically. The housing market cooled, businesses delayed expansion, developers paused projects. The loan volume shrank exactly when the cost of funding it was rising. Laurentian's net interest margin, that critical spread, collapsed to 1.79%. You cannot run a bank on 1.79% when your efficiency ratio is simultaneously deteriorating. And that efficiency ratio is the next number you need to hear. An efficiency ratio measures how much it costs a bank to generate $1 of revenue. The big six Canadian banks, the ones you know, the ones managing trillions, aim to keep their efficiency ratios around 55%. That means they spend roughly 55 cents to earn $1. Lean, profitable, sustainable. Laurentian's efficiency ratio hit 77.2%, 77 cents to make $1. Think about what that means in practice. For the average household, this means the bank managing your deposits, issuing your business line of credit, processing your transactions, was operating with the same financial logic as a business spending nearly everything it earns just to keep the lights on. There is no room for error at 77.2%. There is no buffer. There is no resilience. One more rate hike, one more wave of commercial defaults, one more quarter of slow loan growth, and the math becomes impossible. That is not a prediction. That is math. And so they looked at the numbers. The CEO looked at the projections for 2026 interest rates, looked at the regulatory environment, looked at the competitive pressure from digital banks and the entrenched Big Six, and made a decision that no bank executive makes easily. We cannot survive this on our own. The strategic review that had been running through 2024 and into 2025, which they had framed publicly as a modernization and digitization effort, quietly concluded that the bank's retail banking model was structurally unviable. Too competitive, the CEO said. Regulatory requirements are rising. Translation: the cost of being a legitimate, regulated, deposit-taking institution in Canada has become so high that only the too big to fail giants can bear it. The middle class of banking is being wiped out. Here's what that looks like on the ground. If you were a Laurentian Bank retail customer in December of 2025, you woke up one morning and discovered that you were no longer a Laurentian customer. You are now a National Bank customer. Your account, your history, your relationship transferred. You had no vote. You had no choice. The institution you trusted was dissolved around you, but that's not the real problem. The retail transfer to National Bank is the visible part of the story, the part that gets the headlines, the part that gets discussed on financial news channels between segments about holiday spending and housing market forecasts, the part that is, in reality, the least alarming component of what happened. The part that scares me is where the commercial arm went. This leads us to the system's most crucial secret, which we will explore in the next section. Because the destination of Laurentian's commercial loan portfolio, the loans made to businesses, to developers, to operators across Canada, is not another regulated bank. It is not the CDIC. It is not an institution subject to the same oversight, the same stress tests, the same capital requirements that theoretically keep the financial system stable. It is Fairstone, a private equity-backed alternative lender, operating in what the industry quietly calls the shadow banking sector. And this is the crack that becomes an earthquake. Friends, we were just talking about Laurentian Bank's commercial loan portfolio and where it went after the bank surrendered. Because the destination matters enormously, and most people, when they hear the words alternative lender or private credit, assume this is simply a different kind of bank, a slightly less formal version of the same machine, subject to similar rules, operating under similar constraints. This is where common sense actually becomes your enemy. Shadow banking is not a conspiracy term. It is not the language of alarmists or financial doomsayers. It is a category formally recognized by the Financial Stability Board, the Bank for International Settlements, and central banks around the world. It refers to financial intermediaries, entities that lend money, take on credit risk, and move capital, that operate outside the traditional regulatory perimeter. No CDIC deposit insurance backstop, no mandatory stress tests published for public scrutiny, no Tier 1 capital requirements enforced by OSFI in the same manner. This is not a conspiracy. It is a stated policy framework. The shadow banking sector exists because regulators decided decades ago that not all lending needed to be subject to bank-level oversight. And now Laurentian's commercial loan book, the loans made to businesses that are already showing signs of stress, is moving into that sector. Let me show you what actually happened here, because the sequencing is critical. Laurentian's commercial borrowers were already struggling. That is what the PCL spike told us. Nearly 80% increase in provisions for credit losses in a single year. These are not hypothetical future defaults. These are loans that Laurentian's own risk team flagged as impaired. Businesses that have already begun missing payments. Operators who looked at their 2025 cash flow and realized the debt service was no longer manageable. That portfolio, stressed, deteriorating, built during a low-rate era and now confronting a high-rate reality, is being transferred to an entity with less regulatory visibility and more aggressive recovery mandates. For the average household, this means the small business owner whose line of credit was with Laurentian is now dealing with a private equity-backed lender whose fiduciary obligation is to maximize returns for its fund investors, not to work patiently through a borrower's temporary cash flow difficulty. The forbearance culture that exists in regulated banking, The quiet renegotiation, the payment deferral, the relationship-based accommodation does not carry over into shadow banking with the same reliability. This is the moment small businesses get crushed. And here is where I want to introduce you to the three forces converging simultaneously, because what killed Laurentian was not one problem. It was never one problem. It was a trifecta, three distinct structural pressures arriving at the same time from different directions with compounding force. The first force is the interest rate environment. The Bank of Canada's rate cycle through 2023 and 2024 was the most aggressive tightening in a generation. Rates moved from emergency lows to levels that compressed the operating margins of every institution that had structured its balance sheet for a zero-rate world. Laurentian was particularly exposed because its deposit base was smaller and less stable than the Big Six, meaning the cost of funding its loans rose faster and hurt harder. The net interest margin of 1.79% is the scar left by that force. The second force is the regulatory burden. This is the one that receives the least attention in mainstream coverage, but it is the one the CEO addressed most directly. The compliance cost of operating as a regulated deposit-taking institution in Canada has escalated substantially. OSFI has raised capital requirements. Anti-money laundering frameworks have become more expensive to maintain. The investment in technology infrastructure required to meet modern regulatory expectations, cybersecurity, data sovereignty, digital reporting, has created a fixed cost floor that smaller institutions struggle to clear. When the CEO said the retail banking landscape was too competitive, what she was also saying, in language designed to avoid alarming depositors, was that the regulatory overhead was strangling the business model. This part isn't a prediction, it's math. The third force is commercial real estate and business credit weakness. This is the live detonator. Across Canada, the commercial real estate sector has been absorbing the consequences of higher rates, declining office valuations, and reduced consumer-facing business activity. The loans Laurentian made to developers, retailers, and commercial operators during the low-rate boom are now being serviced in a fundamentally different environment. Cash flows that look comfortable at 2% rates look precarious at 5%. Loan-to-value ratios that appeared conservative when property prices were rising look aggressive when valuations correct. The impaired loan increase was not random. It was the direct consequence of a portfolio built in one interest rate regime being forced to perform in another. Three forces hitting at once from different angles. And here is the part the experts gloss over. None of these forces are temporary. The interest rate environment may ease at the margins, but rates are not returning to zero. The era of free money is structurally over. The regulatory environment is not becoming less demanding. Every financial crisis of the past 20 years has produced more oversight, more compliance requirements, more capital buffers, and commercial real estate weakness is not a one-quarter event. The repricing of that sector is a multi-year process that has not yet reached its endpoint. This is a structural fault line, and Laurentian just fell into it, but that's not the real problem. Because if this were simply about one bank, one specific institution with one specific set of poor decisions and bad luck, the story would end here. Restructure, sell, move on. The system absorbs it. The fortress, bruised but intact, continues standing. The reason this matters, the reason we are having this conversation, is what Laurentian reveals about the institutions you did not hear about this week, the ones that have not yet announced a strategic review, the ones whose efficiency ratios and PCL trends are moving in the same direction, just slightly behind Laurentian on the timeline, the ones whose CEOs are having the same internal conversations that Laurentian's team was having 18 months ago before the public disclosure. Here's the part they never put in the official reports. Laurentian's canary status comes from its size. It is small enough that its distress became undeniable before management could paper over it with a large enough capital raise or a creative enough restructuring announcement. The Big Six have tools available to them: access to wholesale funding markets, diversified revenue streams, massive deposit bases that allow them to absorb margin compression and rising credit losses for longer. They can carry the problem quietly, but carrying it is not the same as not having it. Look at the data points that are publicly available right now without any insider knowledge. The Big Six Canadian banks are all facing some version of the same three forces. Their net interest margins have also been under pressure. Their PCL provisions have also been rising year over year, not at Laurentian's pace, but in the same direction. Their commercial real estate exposures, particularly to the office and retail sectors, are non-trivial. CIBC, for example, has been among the more aggressive lenders to the Canadian real estate development sector. Scotiabank has significant international exposures to markets where the rate cycle and currency dynamics are creating additional stress. And here is the certainty frame that I want you to hold on to. When the small banks fall, the mechanics of the failure do not change. Only the magnitude does. Silicon Valley Bank was not the largest bank in the United States. It was not in the top 10, but its collapse in March of 2023 revealed a structural vulnerability: the duration mismatch between long-dated bond portfolios and short-term deposit obligations that existed inside every institution that had reached for yield during the zero-rate era. SVB fell first because it was most concentrated, most exposed, most dependent on a single depositor type. But the autopsy showed a pathology that was present in varying degrees throughout the system. Credit Suisse did not fail because it was uniquely mismanaged, though it was mismanaged. It failed because when confidence erodes in one institution, depositors and counterparties begin asking harder questions about every institution. The contagion is not caused by the failure itself. The contagion is caused by the transparency the failure forces. Laurentian is showing you what the plague looks like. We don't have months. This is happening in days. If the commercial loan deterioration that drove Laurentian's 80% PCL spike is not specific to Laurentian, and the data strongly suggests it is not, then we should expect Q1 2026 earnings from the Big Six to reflect rising credit loss provisions, not at 80% year-over-year growth. The Big Six are better capitalized, more diversified, and have more tools to manage the optics. But the direction of the trend will be visible, and when institutions that are theoretically the most resilient in the Canadian financial system begin showing rising credit stress in their commercial loan books, the conversation about counterparty risk moves from academic to urgent. For pensions, this is catastrophic in a specific way that almost nobody is discussing. Canadian pension funds, the CPP, the Ontario Teachers, the major provincial plans hold significant allocations to Canadian bank equities. The stability and dividend reliability of the Big Six has made them cornerstone holdings in the conservative liability matching portfolios that fund the retirements of millions of Canadians. If the credit cycle deterioration that is currently visible at Laurentian's level begins migrating upward into the Big Six balance sheets, the impairment is not just to depositors. It is to the dividend streams that pension funds count on to meet their obligations to retirees. The money you think you will have in retirement is not stored in a vault somewhere. It is a claim on assets, on the future earnings of institutions, on the performance of loan books, on the health of the commercial borrowers whose monthly payments fund the dividends that fund the pension contributions that fund your future. When those borrowers begin failing at an accelerating rate, every link in that chain feels the strain. This is the mechanism hiding in plain sight. And here is where I want to stop talking about numbers for a moment, because the numbers are not actually the hardest part of this story. The hardest part, the part that determines whether you come through the next phase of this credit cycle intact or damaged, is not the data. It is your psychology. Human beings are hardwired to believe tomorrow will look like yesterday. Psychologists call it normalcy bias. It is the cognitive architecture that allows us to function without constant anxiety, and it serves us well in stable environments. But in environments where structural breaks are underway, where the architecture of a system is shifting in ways that are not yet fully visible on the surface, normalcy bias becomes a liability. It is the voice that says the banking system has always been safe, therefore it will continue to be safe. It is the instinct that treats Laurentian as an outlier rather than a leading indicator. And this is where everything changes. The normalcy bias is not a character flaw. I want to be clear about that. It is not a sign of ignorance or laziness. Some of the smartest people I know, people who read balance sheets for a living, people who manage capital professionally, are currently sitting with their portfolios unchanged, their deposits undiversified, their exposure to Canadian financial institutions exactly as it was 2 years ago, because their pattern recognition is telling them that this is a temporary disruption, a rough quarter, a small bank's specific problem, something that will be resolved by the next earnings cycle. That instinct has been correct for a long time, and that is precisely why it is so dangerous right now. Here is the part nobody expects. The money illusion is already operating on you, whether you recognize it or not. The money illusion is the phenomenon where people confuse nominal value with real value. You look at your account balance and it says the same number it said last year or a higher number, and your brain registers stability or growth. But if the purchasing power of that number has declined, if the cost of your groceries, your insurance, your housing, your car maintenance has risen faster than the nominal value of your savings, you are becoming poorer while the number stays the same or grows. You become a millionaire on paper, but poorer at the grocery store. This is not theoretical. This is the lived experience of the past 3 years for the majority of Canadian households. And it is not correcting itself because the structural forces driving it, the regulatory consolidation that reduces banking competition, the shadow banking migration that shifts risk out of the visible system, the commercial credit deterioration that threatens dividend streams, are not temporary. They are the new architecture. Let me cut through the noise on the consolidation question, because this is the piece that directly affects your daily financial life. in ways that most commentary glosses over. When HSBC Canada exited the Canadian market, acquired by Royal Bank of Canada in 2024, the competitive landscape for Canadian banking consumers narrowed. One fewer institution competing for your deposits, one fewer institution with an incentive to offer you better rates, lower fees, more flexible terms. The competitive pressure that theoretically keeps the Big Six honest was reduced. Now Laurentian is gone from retail, another institution removed from the competitive field. The branches are absorbed by National Bank, yes, but National Bank is already a major institution. The net effect is not the addition of a new competitor. It is the elimination of one of the few remaining mid-tier players who operated with different incentives, different cost structures, different appetites for certain customer segments. Here's what that looks like on the ground. You are left with fewer choices. And when you have fewer choices in banking, you pay for it. Higher account fees, lower deposit rates, less willingness to negotiate on mortgage terms, less appetite to work with small businesses or self-employed individuals who don't fit the risk model of a trillion-dollar institution optimized for scale and standardization. The oligopoly tightens. And this part isn't a prediction, it's math. But the tightening oligopoly is not actually the end of the story. It is the visible surface. Beneath it, the more consequential shift is what happened to the commercial loan portfolio that did not go to National Bank, the portion that went to Fairstone, the portion that entered the shadow banking sector. What I call the big secret of the entire system is that the regulatory perimeter, the boundary inside which we have deposit insurance, stress tests, OSFI oversight, and the various mechanisms designed to protect the financial system from itself, is not a wall. It is a permeable membrane. And every time a regulated institution transfers assets, loans, or risk into the shadow banking sector, the aggregate risk held inside the regulatory perimeter decreases on paper, while the total systemic risk in the economy remains the same or increases. The risk does not disappear, it migrates. And here is the counterintuitive pivot that the mainstream coverage of Laurentian's breakup completely missed. When Fairstone acquires those commercial loans, those loans do not become safer. They do not become better underwritten. The underlying borrowers, the businesses with stressed cash flows, the developers with projects that are behind schedule and over budget, the operators who were already showing up in Laurentian's impaired loan figures are the same borrowers. Their situations have not changed. What has changed is the institutional context around them. And here is where the cascade becomes unstoppable, because shadow banking entities, when they face stress on their loan portfolios, do not have the same tools or the same mandates as regulated banks. They do not have access to the Bank of Canada's emergency lending facilities in the same way. They do not have deposit bases to draw on for liquidity. They are funded by private capital, institutional investors, pension allocations to private credit, high net worth family office money that has its own redemption timelines, its own risk limits, and its own behavioral patterns under stress. When private credit portfolios begin showing losses, the capital behind them does not sit patiently. It redeems, it rotates, it seeks safety. And when that happens quickly, when the redemption pressure on shadow banking entities accelerates, the loans they hold do not get renegotiated patiently, they get called. Businesses that might have been worked through a rough quarter by a relationship-focused bank find themselves facing accelerated repayment demands from an entity whose investors are simultaneously demanding their capital back. For the average household, this means the small business on your street, the restaurant, the contractor, the retailer that was managing through a difficult rate environment with Laurentian's commercial team suddenly finds itself in a fundamentally different conversation with a fundamentally different kind of lender. This is the moment small businesses get crushed, and it does not stay contained. This is the part that the fortress narrative cannot accommodate, because the fortress narrative depends on the assumption of containment. It depends on the idea that stress in one sector, in one institution, in one asset class can be isolated and absorbed without spreading. That assumption was wrong in 2008 in the United States. It was wrong in 2023 with SVB. And the data we are now seeing from Laurentian's earnings, the PCL spike, the efficiency ratio deterioration, the NIM compression, is the early signal that it is wrong again in Canada in 2026. Here is the detail even analysts tend to miss. The efficiency ratio does not lie. When Laurentian's efficiency ratio reached 77.2%, it was communicating something that went beyond Laurentian's specific management decisions or strategic mistakes. It was communicating that the cost structure of mid-tier Canadian banking had become incompatible with the revenue environment created by the current interest rate and regulatory regime. That is a systemic statement, not an institutional one. If Laurentian, a bank with no dramatic scandals, no exotic derivatives exposure, no rogue trading losses, could not generate an efficiency ratio below 77%, then the question every analyst should be asking right now is, what are the efficiency ratios of the next tier up, and in which direction are they moving? The data forces one conclusion. Now, I want to bring this down to the most personal level because I think there is a tendency in financial content to keep the analysis abstract, to discuss billions and basis points and regulatory frameworks in ways that feel disconnected from the decisions you actually face on a Tuesday morning. So let me be direct. The question this moment is raising is not whether the Canadian banking system is going to collapse tomorrow. It is not whether CIBC or Royal Bank or TD is on the verge of a Laurentian-style dismantling next quarter. Those questions, framed that way, are designed to produce a binary answer that ends the conversation before it produces any useful insight. The real question, the one that actually matters for the decisions you are making right now, is this. Do you own assets or do you own claims on assets? This is not a semantic distinction. It is the most important financial distinction of this particular moment in the cycle. A deposit in a Canadian bank is a claim on an asset. You are a creditor of that institution. Your $50,000 or your $100,000 or your $300,000 is not sitting in a vault with your name on it. It is on a balance sheet, matched against loans, funded by the institution's access to wholesale markets and deposit gathering operations. It is protected up to $100,000 by CDIC deposit insurance, which itself is a claim on the Government of Canada's ability and willingness to backstop the insurance fund in a stress scenario. It is a chain of claims all the way down. Physical gold is not a claim. It is an asset. It does not have a counterparty. It does not have a maturity date. It does not have an efficiency ratio or a net interest margin or a provision for credit losses. When a bank's balance sheet deteriorates, gold does not deteriorate with it. When the shadow banking sector faces redemption pressure, gold does not face redemption pressure. When the regulatory perimeter shifts and risk migrates to less visible corners of the financial system, the gold you hold physically is immune to that migration. This is not an argument for panic. It is not an argument for withdrawing everything from the banking system and burying it in the backyard. It is an argument for understanding the difference between what you actually own and what you have a claim on, and for making sure that in a world where the fortress narrative is showing its first real cracks, you are not entirely dependent on the integrity of that narrative. Here's what that looks like on the ground. The people who came through the 2008 crisis with their wealth most intact were not the ones who predicted the exact day the system would break. They were the ones who had, in the years before the break, quietly shifted a portion of their holdings from claims to assets, from paper to physical, from dependence on counterparty solvency to ownership of things that cannot be restructured, sold to National Bank, or transferred to a private equity-backed shadow lender without their knowledge or consent. Gold and silver are not investments in the traditional sense. They do not generate cash flow. They do not pay dividends. In a stable, growing, low inflation environment, they underperform. I am not here to tell you they are the highest return asset in every market condition. I am here to tell you that in this specific condition, where the architecture of the banking system is under structural stress, where the competitive landscape for consumers is deteriorating, where the risk migration from regulated to unregulated sectors is accelerating, holding some portion of your wealth in assets that exist outside the claim structure of the financial system is not paranoia. It is preparation. And there is one more layer to this that I want to leave you with, because I think it is the most clarifying lens through which to understand everything we have discussed today. The story of Laurentian Bank is not, at its core, a story about one institution making strategic errors. It is a story about a system reaching the limits of a model that was built for a different interest rate world, a different regulatory environment, a different competitive landscape. The 179-year lifespan of Laurentian Bank was not ended by a scandal. It was ended by math, by the accumulated pressure of forces that had been building for years and finally converged at a point where survival was no longer viable. The question is not whether those forces were visible. They were visible. The PCL trends, the NIM compression, the efficiency ratio deterioration, these were all in the public filings, quarter after quarter, available to anyone who chose to look. The question is why so few people were looking, and why the dominant narrative, the fortress, the unshakable system, the safest banking sector in the world, was so powerful that it discouraged the kind of scrutiny that might have prompted earlier action. Normalcy bias, every time. The window for clear-eyed assessment of these dynamics is not permanently open. Credit cycles do not announce their endpoints in advance. The Q1 2026 earnings from CIBC and Scotiabank and the rest of the Big Six will tell us something important about the direction of the commercial credit deterioration that Laurentian's numbers first signaled. If those PCL provisions are rising, if the trend that drove Laurentian's 80% spike in credit loss provisions is visible, even in more muted form, in the trillion-dollar balance sheets of the majors, then the conversation we are having today will look, in retrospect, like an early warning that most people had access to and most people ignored. History favors the prepared, and the window for preparation is closing. The fortress narrative has served its purpose for a long time. It created confidence, encouraged participation, and helped maintain the stability it claimed to describe. But narratives are not balance sheets. They do not absorb losses. They do not prevent the efficiency ratio from hitting 77%. They do not stop the PCL from rising 80% in a year. They do not preserve a 179-year-old institution when the math turns against it. What Laurentian Bank showed us in December of 2025 is that the math is turning, not everywhere at once, not catastrophically, not yet, but in the direction that matters, at a pace that is accelerating, with structural drivers that are not going to reverse. The canary has spoken. The question now is whether you are listening. Friends, that is the complete picture, and I want to leave you with the one action that requires no prediction, no market timing, no special access to information that the institutions themselves don't have. Simply look at your own exposure. Understand what you own versus what you have a claim on. Watch the Q1 2026 PCL numbers from the Big Six with the same attention you would give to any other leading indicator of structural stress. And understand that the moment small institutions begin failing for structural, not idiosyncratic reasons, the question is never whether the contagion will spread. The question is only how far and how fast. We don't have months. This is happening in days. Thank you for being here.